You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Welcome to HECM World Weekly. I'm Gabrielle Hayen. This week, we're looking at a series of stories that all point in the same direction. American homeowners are sitting on record levels of housing wealth, but they're also moving less, working longer, facing rising costs to stay in their homes, and being presented with more ways to access the equity that they've built. And for the reverse mortgage industry, that creates a very important question. What happens when more and more wealth is concentrated inside a home that people increasingly want to keep? Let's get into it. We start with a major new milestone for the U.S. housing market. According to the latest ICE Mortgage Monitor, mortgage holder equity reached $18 trillion for the first time on record during the second quarter. Within that total, 47.5 million mortgage holders hold around $11.7 trillion in tappable equity. That works out to an average of approximately $212,000 per borrower. It's a remarkable amount of wealth sitting inside American homes. ICE also reported that annual home price growth reached 1.5% in July, marking the fifth straight month of acceleration and the strongest annual increase in 14 months. But there are some important nuances. ICE says approximately 813,000 mortgage holders are currently underwater, and that's up 44% from a year ago. Negative equity is particularly concentrated among more recent FHA and VA borrowers, people who bought between 2022 and 2025, and in markets like Texas and Florida, where prices have retreated more sharply from their peaks. So this is not a uniform picture, but nationally, the broader story is clear. Americans have accumulated enormous amounts of housing wealth. Existing home sales fell again in July. The National Association of Realtors reported a 1.7% monthly decline, taking sales to a seasonally adjusted annual rate of 4.06 million. That's still slightly higher than a year ago, and sales across the first 7 months of 2026 are running ahead of the same period last year. So this is not necessarily a collapsing housing market. In fact, home prices continue to hold. The median single-family home price was up 1.9% year over year to around $440,300. What we have instead is a market where transaction activity remains subdued while values remain relatively resilient. And that reinforces a trend we've been examining recently on HECM World, what Benutech co-founder Brian Fox calls the stay-put economy. Fox told us recently that mortgage rate lock-in may have started this trend, but that it is becoming increasingly structural. In his words, it's no longer a temporary tactic. It's more of a long-term financial strategy. And that distinction matters. Even if mortgage rates fall further, millions of homeowners are still sitting on mortgages in the 3% range. Moving can mean taking on a significantly higher housing cost. And in transaction expenses, replacing housing costs and the general disruption of moving and remaining in place becomes financially rational for many households. So when we put these first two stories together, a really important dynamic emerges. Homeowners are accumulating more equity, but they're not necessarily selling their homes to realize that wealth, which means the question increasingly becomes, how do homeowners make that equity useful while remaining in the home? And that is where competition is growing. Home equity investment providers continue to increase their reach. Splatero recently expanded into Idaho, Missouri, Montana, and Wyoming, bringing its total footprint to 17 states. At the same time, Unison completed a $235 million home equity investment securitization, its eighth securitization to date. Taken together, those developments suggest the HEI category is continuing to mature. It's not just about new consumer-facing products. There's also growing geographic distribution and institutional capital sitting behind them. And that matters for the reverse mortgage industry because these products are targeting the same underlying asset, home equity. They're also doing it with a very simple message. As Loan Depot reverse mortgage leader Lisa Moriello told HECM World this week, right now, home equity investment companies are out marketing us. She pointed to the strength of the HEI proposition, no debt, no interest, no monthly payment. It's simple, it's easy to understand, and importantly, it's easy to market. But Lisa's argument is that reverse mortgage professionals should not necessarily try to win the same fight. Instead, she says the industry has an opportunity to win by helping consumers understand the full financial outcome. That means talking through the actual cost, the contractual timeline, how each provider makes money, independent third-party perspectives, and the protections built into the HECM process. As Lisa put it, when you walk a client through these 5 things, they stop comparing marketing pitches and start comparing outcomes. That may become one of the most important competitive skills in this market because homeowners are no longer simply choosing between accessing equity or doing nothing. They're increasingly choosing between different methods of accessing that equity. And there is another reason this conversation matters. Staying in the home is not free. More often than not, it's far from it. A new proposal in the Senate would offer Americans aged 60 and older a tax credit of up to $10,000 for qualifying home modifications designed to help them age in place. The Senior Accessible Housing Tax Credit Act would cover eligible modifications such as wheelchair ramps, handrails, chairlifts, and shower seats, as well as related labor costs. A companion bill has also been introduced in the House. Whether or not the legislation ultimately becomes law, the underlying issue is important. Aging in place is often spoken about as a preference, but turning that preference into reality can require capital. There may be accessible modifications, there are property taxes, insurance, and maintenance, there may be healthcare and caregiving costs, and then there is the normal cost of everyday living. For some households, a $10,000 tax credit could make a meaningful difference. But the broader cost of staying safely and comfortably at home can be much larger. And that connects directly to another shift we're seeing among older Americans. Of approximately 62 million Americans aged 65 and older, around 12 million are still in the workforce, according to Bureau of Labor Statistics estimates cited in recent reporting. And for many, work is not simply about staying busy. An AARP survey found that 41% of people over 50 who were working or looking for work said their main reason was to afford everyday living costs. That's a significant number, and it gives us another reminder that working longer should not automatically be interpreted as a sign of financial strength. For some seniors, it may reflect the need to maintain income because expenses have outpaced retirement resources. It's also influencing housing preferences. Older workers increasingly want low-maintenance properties, proximity to healthcare, access to restaurants and community services, strong internet, and in some cases, dedicated home office space. So even the traditional idea of downsizing is changing. For some older Americans, it's no longer simply about finding a smaller home. It's about finding a home that better supports how they plan to live, work, and age. And that brings us to retirement income. A recent Money.com analysis attempted to categorize retirement income by lifestyle. For a married couple retiring at age 67, including Social Security and all other income sources, the analysis breaks annual retirement income into 6 broad tiers. A lean retirement is estimated at around $40,000 to $65,000 a year. A secure retirement is around $65,000 to $100,000. A comfortable retirement ranges from $100,000 to $175,000. And then the numbers rise significantly. An affluent retirement is estimated at $175,000 to $350,000 a year. A luxury retirement ranges from $350,000 to $750,000. And what the analysis calls an ultra-rich retirement requires annual income of $750,000 or more. Now, those labels are obviously subjective, and geography, healthcare costs, housing expenses, and personal expectations can dramatically change what any of those numbers mean. But with that full range in front of us, there's a more interesting question for the retirement and home equity industries. How closely does the income people actually have in retirement align with the lifestyle they expect to maintain? Because when there's a gap, households only have so many levers to pull. They can work longer, they can spend less, they can draw down investments more aggressively, they can move or downsize, or they can begin to look differently at another major asset sitting on their balance sheet, their home. That does not mean home equity should automatically be accessed, and it certainly does not mean that every equity access product is appropriate for every homeowner. But in a world of longer retirements, rising costs, and record housing wealth, it becomes increasingly difficult to treat the home as completely separate from the retirement income conversation. And finally, in direct reverse mortgage industry news, HUD has revived plans for its HNVLS 2026-1 loan sale. HUD now plans to sell approximately 1,500 secretary-held reverse mortgage notes totaling around $465 million. Bidding is scheduled for September 1st. The loans are associated with occupied properties where the borrower and any borrowing or non-borrowing spouse have died and heirs have not come forward. The original proposal involved approximately 2,500 loans totaling $730 million before that sale was postponed. HUD says the program is designed to reduce risk to the Mutual Mortgage Insurance Fund while efficiently disposing of secretary-held assets. It will be worth watching how the smaller, revived pool progresses. So, when we put all this together, the common thread becomes pretty clear. Americans have accumulated record levels of housing wealth, but they're moving less. Alternative equity products are becoming more established. Policymakers are acknowledging the cost of staying in the home. Millions of older Americans are still working, often because everyday expenses require it. And the income needed to support the retirement lifestyle many people expect may exceed what traditional retirement resources can comfortably provide. For the reverse mortgage industry, that creates both an opportunity and a responsibility. The conversation is increasingly about more than a mortgage. It's about helping homeowners understand where their housing wealth fits alongside income, investments, debt, longevity, and their desire to remain at home. The key question may no longer simply be, how much wealth does this homeowner have? It may be, can they actually use that wealth in a way that supports the life that they want to live? That's it for this edition of HECM World Weekly. I'm Gabrielle Hayen. Thanks for listening, and we'll see you next week.